All right, let's jump right into this explainer where we put Willdan Group through the ultimate valuation stress test. Honestly, as an investment analyst, there is absolutely nothing I love more than taking a company's raw data and running it through the legendary frameworks of Warren Buffett, Peter Lynch, Benjamin Graham, and modern financial modeling. We are going to find out exactly what this stock is truly worth.
Here's the game plan for today. First, a quick company snapshot, followed by the Buffett, Lynch, and Graham lenses. Then, we'll crunch some modern math and wrap it all up with our final verdict.
First up, Section 1, getting our company's snapshot and establishing a baseline. So who exactly is Willdan? Well, they're an industrial engineering and consulting firm. They're heavily involved in energy efficiency, program design, and smart grid optimization. Basically, they're riding this massive wave of infrastructure investment, sitting right at that sweet spot between energy demand and complex engineering. Looking at the baseline numbers, we're talking about a $1.1 billion market cap company, currently trading right around $74 a share. Over the last 12 months, they've pulled in over $681 million in revenue and a really solid $52.6 million in net income.
Moving on to Section 2, let's look at this through the Warren Buffett lens.
Willdan actually crushes Buffett's qualitative checklist. They've got a very high economic moat since they're so deeply embedded in public sector and utility contracts. Earnings are super consistent too. Net income actually skyrocketed over 143% year over year. Return on equity is a very healthy 17.2%, and they do it with beautifully low debt. Their debt-to-equity ratio is just 0.16, meaning for every dollar of equity, they only have 16 cents of debt. That is massive financial flexibility right there. Plus, management confidently raised their full-year guidance. Now, Buffett is obsessed with cash. If we calculate his famous owner earnings, which means taking that $52.6 million in net income, adding back $18.7 million for depreciation, and subtracting $9.4 million in capex, we get about $61.8 million. This business is literally a highly efficient cash-generating machine.
All right, Section 3. Let's see what Peter Lynch would think by categorizing their growth. With EBITDA projected to grow anywhere from 26 to 32%, Lynch would undoubtedly label Willdan a fast grower. And because of that aggressive growth, they have an absolutely gorgeous PEG ratio of roughly 0.46. That's their 13.8 forward PE divided by a 30-ish% growth rate. Anything under 1.0 is phenomenal in Lynch's playbook. But we do need to point out one slight red flag. Bard Associates recently sold off $7.7 million in shares. That kind of institutional dumping is definitely something to keep an eye on.
Lynch also demands a rock-solid balance sheet to weather economic storms, with actual debt notes making up less than 10% of their total liability structure. Willdan is extremely well-capitalized, plain and simple, without relying on heavy borrowing. Next up, Section 4. Time for the strict, conservative math of the Benjamin Graham lens. Now, Graham is famously strict. While Willdan passes on adequate size and has a moderate forward PE, it totally fails his liquidity test with a 1.67 current ratio. He wants to see that over 2.0. And its price-to-book multiple is sitting at 3.6, which is way, way above Graham's absolute maximum of 1.5. Spoiler alert, he'd hate this valuation.
Let's actually run the math here. If we plug Willdan's adjusted EPS of $4.89, along with their roughly $20.22 book value per share, into Graham's famous intrinsic value formula, we end up with an intrinsic value of about $47.16 per share.
So with the stock currently trading up around $74, Willdan offers zero margin of safety compared to that $47 valuation. A classic value purist just wouldn't touch this stock today. There just aren't enough hard, tangible assets to back up that premium price tag.
Okay, Section 5, let's move into modern math and forecast some cash flows. Building out our discounted cash flow, or DCF model, we're starting with a baseline free cash flow of $70.7 million. We'll project a fairly conservative 15% growth rate over the next 5 years, apply a standard 10% weighted average cost of capital to account for market risk, and assume a 2.5% terminal growth rate to basically match long-term inflation. When we run those numbers, we get this really revealing sensitivity table. Sticking to our base assumptions, right in the center, the DCF model points to a fair value of $97.50 per share. So unlike the strict Graham model, modern cash flow analysis tells us the stock is actually undervalued today based on its future earning power. And we can totally back this up by looking at comparable multiples. Willdan's projected forward PE for 2028 is just 13.8. That is incredibly cheap when you compare it to the broader S&P 500 average, which usually hovers right around a 20 multiple. Think about it like this. If Willdan just traded at that average market multiple of 20 times its projected 2028 earnings of $5.14 per share, its fair value would skyrocket to $102.80. Wall Street is clearly discounting the stock compared to the rest of the market. Finally, Section 6. Let's pull this all together for our synthesis and final verdict. The investment case here is basically a massive tug of war. On one hand, you've got incredible business momentum, huge infrastructure tailwinds, and serious cash generation. But you really have to weigh that against the strict asset overvaluation, that institutional selling we noticed, and its vulnerability to macroeconomic events, like the 2025 tariff shock that temporarily knocked the stock down 7%. Our synthesis matrix reveals a really fascinating split. Willdan is highly overvalued on a historical hard asset basis. Graham absolutely hates it. But it's deeply undervalued when you base it on projected growth and free cash flows, which means modern DCF models and Peter Lynch frameworks absolutely love it. So blending all these philosophies together, we're giving Willdan a hold right here at $74. Now Lynch, he would buy it today just for that sheer growth profile. Buffett would probably wait for a slight market dip to around $65 to get a fair price for a wonderful business. And Graham wouldn't even look at it unless it crashed below $40 to guarantee a deep margin of safety against his $47 intrinsic value. Which leaves us with Benjamin Graham's famous reminder. In the short run, the market is a voting machine, but in the long run, it is a weighing machine. So what do you think? Will Willdan's incredible cash-generating machine outpace its thin asset book value over the next decade? Or will gravity eventually pull this infrastructure darling back down to earth? Let that weigh on your mind and your portfolio.